I will
is
do
entirely
is
in line.
now, Senator Whish-Wilson, I'll give you the call. We are scheduled to go to the next agency in about 12 minutes. So,
okay. I think Senator Waters has asked some good questions. So just a few points of clarification. So, how many invested managers do you use, Mr. Neal? Is there a long list of them in terms of the mandate?
How many investment managers we employ? I think the number is just over 100. The names of all the managers we employ are on our website.
Okay, and are they across different asset classes, or how do you select those?
They are across all the whole range of asset classes that we invest in. Obviously, all of our assets are invested through investment managers, so they are across the full spread.
Do you make decisions at a board level as to your asset allocation?
That's right, we do.
So you make decisions around asset allocation as asset classes, but you said that the risks, any climate risks, carbon risks, whatever you want to call them, are integrated into the system through your investment managers.
That's right, the decisions they make on particular investments.
Okay.
That's right.
Across different asset classes.
That's right.
Okay, but if you don't know what your exposure is to I think there's about 400 different systems for measuring carbon risk at the moment, so there's no global standard. Do you know if any of your investment managers themselves actually do adopt standards for measuring carbon risk?
So we would expect each of our investment managers to have. We don't tell our investment managers how to manage money. They all do it. Part of the reason why you have a diversified portfolio of managers is that you have a number of different processes and perspectives that drive the way that the decisions are being made. That improves the diversification in the portfolio. Our managers would all have their own process for understanding the risks that come from whether it be commodity prices or any other risk that may impact the future value of that company. They have their own processes for doing that. Some of them may decide to do it in one way, and some will do it in another. We don't prescribe to them. What we prescribe to them is we would like you to generate strong returns, and in doing so have regard to the full range of risks affecting that company.
It seems to me that some investment managers across different asset classes do and don't price carbon risk. We know that, for example, the banks here in Australia have adopted a project where they're doing that. I know insurance companies do, some energy companies do, some infrastructure companies do, but it's not a... Oh, sorry, Joe, lucky it wasn't full. But so I'm just wondering how you know that these risks have been managed when you don't actually know whether your investment managers have policies around those risks. I mean, some of them don't even acknowledge climate risks.
So we engage with our managers and we understand our managers' processes to ensure that they have a high quality approach, the skills, experience, resources, processes required to manage money well on behalf of the taxpayer. So there's considerable effort put into that. I think our performance would suggest that we're doing a reasonably good job of that. We've generated strong returns over quite a long period of time and significantly in excess of the average fund in Australia. That's done through high-quality managers understanding the risks that they are exposing the portfolio to and managing those risks accordingly. Understanding the sorts of things that you've just said are exactly what we would expect them, and I'm sure they do, to understand how every company they invest in is managing their exposure to every risk in the portfolio.
Okay, so part of what Senator Waters said is important. Your government mandated, and you're using taxpayers' money to invest. For private investors, investment managers, or individual companies, the disclosure of this information is about providing information so investors can make a choice. They can actually see what risk exposures there are in certain asset categories related to climate risk. We don't, obviously, you don't need to do that because it's not a competitive process to get money. I mean, you take out taxpayers' dollars. But if the government actually mandated you to actually provide some sort of audit of your exposure to climate risk or to carbon to carbon pricing. Would you be able to do that? You said earlier that was too complicated.
Well, if I suppose if Parliament generated a law that required us to report, we would do our best to report that information.
And that would come at a cost, of course, which would lower the achievable rate of return, which would leave the taxpayers short when it comes to funding, fully funding the unfunded Commonwealth superannuation liability.
You're
which
offering
is why,
an investment opinion now.
well, no, what I'm offering you is a position on behalf of the Australian government, is that we are working within the legislation set by the Parliament, that consistent with the Act that was passed by the Parliament, we have provided an investment mandate to the Future Fund, and that we are satisfied that the investment mandate that we've provided to the Future Fund is the appropriate investment mandate, given what the Parliament has said to us, the government. It was that the Parliament wanted us to achieve.
I know there were some submissions to Murray's FSI requiring the Future Fund to do this, including from some very eminent financial services companies. But I'm interested, Senator Waters also talked about Mr Carney's speech in the Bank of England talking about leadership in this area, because I agree it is quite motley and different approaches are taken all around the world. And he talked about the Financial Stability Board bringing together institutions from each country to actually look at a way that we could standardise this kind of risk around investment management. Are you aware of the Climate Disclosure Task Force that's been set up to actually look at ways of simplifying and making it easier to disclose carbon risks for organisations such as yours?
I'm sure my team is. I'm not personally aware of that or across the details of that, no.
Okay. Just in relation to something you said earlier, you talked about examples of commodity prices and coal, and you would factor that into your investment decisions. And I certainly hope if you were holding the coal company, Senator Waters was talking about you saw a long time ago that the writing was on the wall and you divested yourself of those. But I'm interested whether you can comment on whether you divested any renewable energy investments in this country around political risk associated with the removal of the carbon package, the carbon price and renewable energy targets, those kind of things. You've been through that? No.
I don't believe that we have, no.
Okay. Do any of your investment managers provide like seed capital or early stage equity funding, or is it all, so is there any risk capital?
We would have some of our private equity managers that do provide very early stage capital, that's right.
Okay. Could I ask you, just as a matter of interest, there's been a bit of commentary lately on your cash holdings being very high. Could you give the committee a little bit of an idea about your thinking about having nearly 20% of your total holdings in cash? Is that correct?
That was the figure at June. I provided the committee a little earlier with an update. It's down to 15.1% as at the end of September.
Right.
One of the reasons why our cash holding moves around quite a lot is that we have a relatively large exposure to foreign investments in the portfolio. We're a large fund seeking to be globally diversified. Our currency move tends to mean that our cash weightings rise and fall fairly considerably, given that we hedge some of those currency risks. It's just a mechanical feature of the way that hedging process works, that cash levels can be reasonably volatile. But it is fair to say that we have got a higher level of cash in our portfolio now than we would consider a norm over time. That's a function of our views on the global sort of macroeconomic and market outlook. We believe that prospective returns are relatively low at the moment, and we believe that risks are relatively high at the moment. So that causes us to want to be a little more conservative with the portfolio than we might otherwise be. So that's a reason why our cash levels are a little higher than normal.
So when you're saying risks, can you give us a bit more insight? Are you talking about global growth, or are you talking about specific asset classes like global equities being overvalued? What's the...
So at a total portfolio level,
Yeah.
such as that we were just talking about, the key risks that I'd highlight, there are many. The key risks that I would highlight that we touched on earlier would be risks around US monetary policy and whether the US economy will be able to withstand rising interest rates and how it will cope with rising interest rates and what the implications are if it can't cope with the normalisation of interest rates. There's the knock-on effects to the rest of the world of US interest rates rising and the impact that has on, particularly on many emerging markets where a lot of government and perhaps more particularly corporate companies have borrowed in US dollars, and so the implications for them of that kind of risk. There's risks around China and their ability to transition that economy efficiently and effectively, and any bumps in the road on that path and what that might mean for the global economy, given the scale of the Chinese economy itself. There are risks around the sort of structure of the Eurozone, whether that's how sustainable that is, what progress they make towards becoming more of a single, so more like a single country, if you like, more integrated, and what some of the risks might be if they don't manage to continue down that path. So there are always, and there's geopolitical risks, obviously. There are always many things that we have to take into account when managing a globally diversified portfolio.
So with your cash holdings, are they predominantly Australian dollar cash holdings, or are they in different currencies?
They are nearly all Australian dollar. We do have some foreign currency holdings, foreign cash holdings as well, but the vast majority is Australian.
Okay. And so the fall in the dollar, that'll affect your overall returns if they've been sitting in Australian dollars for some time, or?
Well, a fall in the Australian dollar is actually very good for our investment returns, all other things being equal, because we have foreign investments which go up in value. So that tends to generate positive returns. To the extent that we hedge that currency exposure back, then we give some of that return back. But it's
would I be right to read then you've sold some of your foreign equity or bond assets to cash in on the low dollar? So you've taken a position on the dollar? Or?
No, we don't particularly take a position on the dollar. The way we manage currency is to think about it's to balance the overall portfolio risk. So it's very difficult to trade currencies. That's not something that we think we have a particular competitive advantage in doing. We decide what basket of foreign currencies makes sense for us.
Well, that would be speculation, wouldn't it?
It would be, well, some people might describe it as speculation. Some people manage to do it quite successfully. I think the important thing as an investor is to recognise what you believe you can do and stick to that.
So the last question, Chair, just as a matter of interest, though, when you make a decision at board level that you're going to change your asset allocation and move to increase your holding in cash, across all your 100 investment managers, if you want to reduce your exposure in equities, do you just tell all of them they need to lighten a certain percentage, or do you cherry pick who actually? How does the process work?
It can happen in a variety of ways. So that's a decision that we might make. We may choose to take it all from one manager. We may choose to take it from a variety of them. We can also use the futures markets to change our exposures. So there are a variety of different ways that we might do that. It really depends on why we're reducing that exposure and where we believe we should most efficiently take it from. So there's no set rule for that.
Thank you.
Thank you very much, Senator Whish-Wilson. Mr. Neil, I think that concludes questioning.